Hello everybody! Do you want to become a master in trading chart patterns but always get confused which pattern you actually see on your chart? Well, let me help you. I have compiled a list of the 23 most important and most common chart patterns. In this video, I will explain the 23 trading patterns every beginner or advanced trader should know. I will also explain how you can find those trading patterns on a chart together with how you actually know when to take a trade and where to put your stop loss and take profit. And I will explain how to know when a pattern is not actually the pattern you are looking for. Well, that being said, let's start with the most common and most basic pattern of them all. Just a quick note before we start, everything said in this video is no financial advice. I got all my information on the internet and from my own experiences. It's basic knowledge that you should use your own edge when trading and shouldn't completely rely on trading patterns. I hope this is logically, but these days you have to make everything clear before you get a lawsuit on your head. That being said, I've marked all the patterns with timestamps in the video description. If you want to skip between patterns, you can easily do so through the description. It took me way too long to create this video and I'm not getting anything in return yet, since everything in this video is free. So a like and subscribe will be appreciated. Now, let's start with pattern number 1. The pennant. The pennant comes in two variations, a bullish pennant and a bearish pennant. This can also be seen on the screen. We can identify a pennant by its two lines acting as support and resistance. The lines slope to each other till they meet each other. This is called the breakout point. The breakouts can either be to the upside or downside. Like shown in the different variations, a pennant can either be bullish or bearish. There's no exact way to know if it's going to break to the up or downside. However, if the pennant is formed in a downtrend, then the chances of it breaking to the downside is much higher than when it's created in an uptrend. The pennant is the only trading pattern that doesn't have a clear target when it breaks out. It can either be bullish or bearish. Like said before, you can get an indication as in where it's going based on the trend. In order to trade a pennant, you need a trade setup. A trade setup can something be like the one showing on the screen. Because we're working with a bullish pennant, you want to take a long position. You might wonder, how do we know it's a bullish pennant? Well, we don't. That's why we will wait for a confirmation candle. Some more information on that in a second. So, in order to enter the long position, you need to decide your entry price, your take profit, and your stop loss. And here it comes. You only want to enter the trade after at least one candle is closed outside the pennant. This is to make sure it will actually play out the direction you were expecting. When placing your take profit and stop loss, make sure to always have a risk-reward ratio of at least 1.5. This is so you have an edge over your losing trades. Pennants can also have fakeouts. A fakeout is something like the one showing on the screen. It's the moment when you think it's going to break down or up, but the candle hasn't closed yet and so it's not an actual breakout yet. That's why we always wait for a second candle close before entering the trade. All you need to keep in mind by a pennant is that it will cause volatility to either the upside or to the downside. Now let's talk about the symmetrical triangle. The symmetrical triangle is another one of those really easy to spot patterns. It's almost the same as a pennant, however it has two variations, a bullish symmetrical triangle and a bearish symmetrical triangle. A bullish symmetrical triangle always starts after a pump to the upside, followed by some consolidation. If a bullish symmetrical triangle is formed, then this will cause another pump once it breaks to the upside. It will only break once it comes close to the breaking point, like explained with the pennant. A bearish symmetrical triangle is the same as a bullish symmetrical triangle. However, it is created by a dump, followed by consolidation where the symmetrical triangle is created. If it's properly created, then a bearish symmetrical triangle is always followed by another dump. The symmetrical triangle can be traded in the same way as a pennant. Make sure the right conditions are there for the symmetrical triangle, like described above. Also make sure to wait for at least one candle close to close outside the symmetrical triangle before entering your trade. Now let's get a bit more advanced, shall we? A descending triangle only comes in one form, a bearish form. So what happened to the bullish variation? Well, some argue that it's the same pattern, however, the bullish variation is called an ascending triangle. I'll give some more information about that one in pattern number 4. The support line is straight, and so the descending triangle can only be played out if it gets held up by a support line. The resistance line is downward sloping till it meets the support line. Once both of those lines meet, then, you guessed it, that's called the breaking point. Like mentioned earlier, a descending triangle can only be bearish, and so it has to break to the downside. I already gave some clues about this one, but the ascending triangle is the bullish variation of the descending triangle. It's completely the same, but only occurs after a pump followed by the ascending triangle. The ascending triangle is created when this time not the support line is straight, but the resistance line is straight. So in order for the ascending triangle to play out, it needs to be resisted by a resistance line. The candles need to make higher highs and need to be supported by an upward sloping support line. Once the support and resistance line meets, then this is called the breaking point. The ascending triangle only comes in a bullish form, so the breakout will be to the upside if drawn correctly. The infamous falling wedge. Like the name suggests, this pattern is literally a falling wedge. The falling wedge comes in one variation and one variation only, and that's the bullish variation. It's being formed after a pump to the upside, followed by candles that make lower lows. Those lower low candles get tighter and tighter till they meet the two downward sloping lines that act as support and resistance. Once the candles come to the end of the falling wedge, then this is called the breakout point. The falling wedge also has a brother. It's called the rising wedge. The rising wedge is again exactly the same as the falling wedge, but this time the wedge is rising, like the name suggests. The rising wedge is the bearish variation of the falling wedge. The rising wedge is created after a dump, followed by consolidation where the rising wedge is created. The rising wedge trades upwards, with the candles making higher highs. The candles get supported and resisted by two upward sloping lines that get tighter and tighter till they meet each other. Once the candles trade into the two lines where they meet, then this is called the breakout point. The bull flag. The bull flag is one of the most recognizable and common patterns next to the pennant. The bull flag is a continuation pattern that is being created after a pump followed by some consolidation. If the candles of the consolidations make higher highs and they trade within the two linear lines, then this is called a bull flag. The bull flag can only break to the upside. If it doesn't, then this was not a proper bull flag. Once the resistance line can't act as resistance anymore, then the candle breaks out of the flag and you have a confirmed bull flag. Once the candle broke to the upside, then the uptrend will keep going. The bear flag is the opposite of the bull flag pattern. It's a continuation pattern that occurs during a downtrend. It is formed after a dump, followed by consolidation where the bear flag trades in a small channel to the upside. The candles make higher highs and trade within two linear, upward sloping support and resistance lines. Once the support line isn't strong enough anymore, then the candle will break to the downside, creating a breakdown. Oh, I'm not sure if I mentioned it yet, but yes, it's a bearish pattern for everyone who hasn't noticed yet. So yes, it's a basic pattern that everyone should know about because it occurs a lot on trading charts. The double bottom is one of the easiest patterns to spot. Like the name suggests, it are two bottoms after a downtrend that marks a reversal. Once the price breaks above the neckline of the second bottom, then the double bottom is being played out and a reversal of the trend is on its way. The double bottom is unique because it works really well on smaller time frames instead of only big time frames. So if you spot a double bottom on the 5-minute chart, then this is definitely a good indication of a short-term reversal in the trend. So keep that in mind when you're trading and you see a double bottom. Now let's also shortly talk about the enemy of the double bottom. It's called the double top. The double top is, like the name also suggests, two tops forming after an uptrend. Once the double top is formed and the price breaks under the neckline of the second top, then this will mark the reversal in the trend. And the double top can also be used on smaller time frames just like the double bottom. The head and shoulders pattern is one of the most reliable reversal patterns. It is formed by three peaks, with the middle peak being the highest and referred to as the head. The other two peaks are referred to as the shoulders. The pattern is confirmed when the price breaks below the neckline, which is a support level that connects the bottoms of the left and right shoulders. Keep in mind that the picture you're currently looking at is not how every head and shoulders pattern looks like. Sometimes the head of the pattern can be a bit higher, a bit lower, a bit bigger, or even a bit smaller. The shoulders of the patterns also don't need to be perfectly aligned together. The shoulder can also be a bit higher or lower, or that one of the shoulders is just a bit higher than the other one. Just keep in mind that a head and shoulders pattern doesn't necessarily need to be perfectly aligned like shown on the screen. The inverse head and shoulders is the bullish variation of the head and shoulders pattern. It is formed by 3 bottoms, with the middle bottom being the lowest and referred to as the head. The other 2 bottoms are referred to as the shoulders. The pattern is confirmed when the price breaks above the neckline, which is the resistance level that connects the tops of the left and right shoulders. So it's basically the same as the head and shoulders pattern, but then flipped upside down. That's why it's the bullish variation of the head and shoulders pattern. Oh, and everything I said about the head and shoulders pattern also applies to the inverse head and shoulders pattern. The rounding top is a pattern that occurs during an uptrend. It is formed by a series of higher highs and higher lows that gradually lose momentum, resulting in a round-shaped top. The pattern is confirmed when the price breaks below support, which is the lowest point of the rounding top. Traders often use this pattern to identify a potential trend reversal from bullish to bearish. The rounding top can only be traded once the candle closed below the lowest point on the rounding top. If you are experiencing a rounding top while you're trading but your rounding top has major wicks that make the rounding top look weird, but the candles are still closing in the form of a rounding top, then it's still a rounding top and can still be traded. However, do note that the rounding top should not be used as a single pattern and should always be used next to a resistance area to give further confirmation of a shift in the trend. Now let's also immediately look at the enemy of the rounding top, the rounding bottom. The rounding bottom is, like the name already suggests, the same as the rounding top but flipped upside down. The rounding top is a bullish counterpart of the rounding top. It is formed by a series of lower lows and lower highs that gradually gain momentum, resulting in a rounded shape. The pattern is confirmed when the price breaks above the resistance level, which is the highest point of the rounding bottom. The rounding bottom should also not be used as a single trading signal and should always be used with a support line to indicate a future reversal in the trend. Now, let's talk about the cup and handle pattern. The cup and handle pattern is a bullish continuation pattern that occurs during an uptrend. It is formed by a cup shape which is followed by a handle. The pattern is confirmed when the price breaks out above the handle. It's called a cup and handle pattern because it forms a cup after a handle. Traders can identify this pattern because it looks like a pen with a steel. The cup and handle pattern doesn't occur much on trading charts, however when it does, then this will be a confident confirmation for a breakout. Do note that you should not use the cup and handle pattern alone on the chart, and you should always use the support line to give that extra confirmation. The triple top reversal pattern is a bearish pattern that occurs after an uptrend. It's basically the same as a double top, but with one more top which is placed in the middle. The triple top is confirmed once the 3 tops are made and the price falls below the neckline of the 3 tops. This pattern doesn't occur much on trading charts, but once it does, then it confirms a big shift in the trend of the market. So, now that we're talking about triple tops, let's immediately talk about the triple bottom reversal. Like the name suggests, it's the same as a triple top reversal, but then in a bullish variation. It starts after a downtrend, followed by 3 bottoms. Once the last bottom is confirmed and the price breaks the neckline of the 3 bottoms, an uptrend will be started if drawn correctly. Triple tops and bottoms are a great way to identify a potential trend shift. However, you should always use extra confirmation patterns or indicators to confirm an actual trend shift. Now, let's talk about a few more advanced trading patterns. The bearish price channel pattern. The bearish price channel pattern is a bearish continuation pattern that occurs during a downtrend. It is formed by 2 parallel trend lines with a price action contained between them. The upper trend line acts as resistance while the lower trend line acts as support. The pattern is confirmed when the price breaks below the lower trend line. This pattern can actually come in 2 variations, and they are both bearish. The price channel can either slope upwards or downwards. I do have to mention that it's only bearish when it's being formed in a downtrend. This is different from most patterns, so keep that in mind. This pattern can also take a longer time to play out than other patterns and works most efficiently on higher time frames. Now that being said, let me introduce you to a friend of the bearish price channel, the bullish price channel pattern. The bullish price channel is a bullish continuation pattern that occurs during an uptrend. It's basically the same as a bearish price channel, but then in a bullish format obviously. It is formed by two parallel trend lines with a price action contained between them. The lower trend line acts as support, while the upper trend line acts as resistance. The pattern is confirmed when the price breaks above the upper trend line. And also, the bullish price channel can either slope upwards or downwards, and in both scenarios it will be bullish, of course as long as it's being created in an uptrend. A lookalike of the bullish price channel is the bullish rectangle. It's a continuation pattern that occurs during an uptrend. It is formed by a rectangular consolidation pattern that occurs after a sharp price increase. The rectangle is formed as the price consolidates in a narrow range, usually within two parallel trend lines. The upper line acts as resistance while the lower one acts as support. The pattern is confirmed when the price breaks out above the upper trend line, also known as the breaking point of the resistance. It's almost the same as a bullish price channel, however, this one doesn't slope upwards or downwards. The bearish rectangle is the opposite of the bullish rectangle. It is a continuation pattern that occurs during a downtrend. It is formed by a rectangular consolidation pattern that occurs after a sharp price decrease. The rectangle is formed as the price consolidates in a narrow range, usually within two parallel trend lines. The pattern is confirmed when a price breaks out below the trend line, also known as the breaking point of the support. And yes, just like the bullish rectangle, the upper line will act as resistance, while the lower one acts as support. And in comparison to the bullish rectangle, this one is only being formed in the downtrend. And just like the bullish rectangle, this one also doesn't slope upwards or downwards. And I know I'm repeating myself from the bullish rectangle, but I need to for the people who skip between patterns, so I have to explain it twice. Sorry to the people who watched the full video. The diamond top is a bearish reversal pattern that occurs during an uptrend. It is formed by a series of higher highs and lower lows that create a diamond-shaped pattern. That's also why it's called a diamond top. The pattern is confirmed when the price breaks below the support level, which is the lowest point of the diamond shape. The diamond top can take a longer time to form and is harder to identify in lower time frames, so I would only recommend trading this pattern on higher time frames. So now that we're already talking about it, let's immediately talk about the diamond bottom. The diamond bottom is a bullish reversal pattern instead of a bearish one that occurs during a downtrend. It is formed by a series of lower highs and higher lows that create a diamond-shaped pattern, hence the name diamond bottom. The pattern is confirmed when the price breaks above the resistance level, which is the highest point of the diamond shape. And that's a wrap of the 23 most important trading patterns every trader should know about. This was probably the most basic but efficient chart patterns course you will ever watch for free. You can also bookmark this video in case you're trading and you want to double check if it's the pattern you're actually looking for, or if you want some more information about the pattern you're looking at. I hope I gave useful information about the different trading patterns you can use in your own trading. If I did so, then please consider liking this video and subscribing to my channel for more free courses about trading just like this one. I also have a free Telegram group you can join where I post all my trades and daily market analysis. I have it linked in the description. And last but not least, if you want to start trading crypto but you don't have an exchange yet, then I would recommend using Bybit. It's the exchange I'm using every day to trade, and if you use my link in the description, you get the deposit bonus up to $30,000 and 25% off fees. And yes, I also get a small commission if you use my link. All visuals are self-made and so they are copyrighted by me, Justin Galen. Like said before, everything I said and explained in this video is no financial advice. And that's it. Happy trading everyone.